Today we are going to discuss our study session 9. This includes inventories, long-lived assets, and income tax and long-term liabilities and leases. We will focus on these two topics, and in the next lecture we will finish the income tax and long-term liabilities. Broadly, in inventories we have to discuss the methods for valuation of stock or inventories, that is last in first out, first in first out, then the weighted average cost method, then relationship among and the usefulness of the inventory and the cost of goods sold provided by the LIFO, FIFO and the average cost method, when the prices are stable and when the prices are changing. When prices are changing, so generally last in first out will be on the higher price because current price will be higher than the first one. So in multiple choice question we have to make it in mind that if we are going to use LIFO, so how much it is going to affect the prices, means positively or negatively. How inventories are reported in the financial statement and how the lawyer of cost or market principle is used and applied. Then we will see effect of capitalizing versus expensing on the net income shareholder equity. Capitalization is when you do some expenditure and you don't expense it, means you don't record it into the income statement, you charge it to the balance sheet. So what effect it is going to give the shareholder equity, cash flow from operations and financial ratios. Then intangible assets which has no physical existence like software, copyrights, patents, which should develop cost and research and development cost should be capitalized according to US GAAP and International Accounting Standard. So we will see in GAAPs when we can capitalize the intangible asset and in IFRS when we can do it. Then we have to learn depreciation methods. Depreciation is the value, decrease in the value of fixed asset. Generally used here the straight line, and there is a double reducing balance method. Affects the company financial statement, ratios and taxes. Depreciation method, the estimated useful life and the salvage value used in accounting for long-lived asset affect financial statement and the ratios. Then average age and average depreciable life of a company asset using the company's fixed asset disclosures. Impairment, because asset lose its value, sometimes you have to check the impairment. So that charges on the fixed asset or long-lived asset and analyze the effect of taking such impairment charges on the company financial statements and ratios. Then accounting requirements related to identify environmental damage caused by the operating assets. We will learn that some assets, like if we are an oil company or we are some company which working is directly polluting the environment, so before the start of acquisition of the asset, we have to keep the provision for the asset retirement. It will be a little costly for the company because they have to install some devices to save the environment. All that this we will discuss. So income tax and the other portion we will discuss in the next lecture. Now we will start our discussion from inventory. If you see the inventory account, generally you have an opening balance and then you have a closing balance. This is a typical accounting T-ledger account. It's showing you the opening balance, closing balance. During the year, because inventory is normally all assets are debit, so opening balance is debit. Purchases always debit, so this is only debit side. And when you will transfer it to the cost of goods sold, this account will be credited and cost of goods sold account will be debited. So this will give you an idea that inventory or cost of goods sold is related with the opening inventory, add purchases or less closing stock. Now let's discuss the basic inventory equation based on this thing. If you have this thing missing, but if you have these three things, you can find it out. So that's why we make it an equation. Ending inventory is equal to beginning inventory plus purchases minus cost of goods sold. You can see here, if you want to find this one, so these two should be added, and this minus this will be closing balance. That's why this equation, ending inventory is equal to beginning inventory plus purchases minus cost of goods sold. Or if you want to find purchases, then you have to take the ending inventory minus beginning inventory plus cost of goods sold. So it's like manipulation of this concept. Whatever figure you want, you can fit in and you get the value of the missing item. Now, what is included in the cost of inventory? For example, your supplier is in US, is selling you some items, and the item unit is, say, in meters, and price is $100 per meter, right? This is the cost. Now, this cost is called purchase cost. Then we have conversion cost. Then allocation of fixed production overheads. Other cost necessary to bring inventory to its present location and condition, that is freight. So that's why the purchase cost is only the cost that we agreed with the supplier. Then we have to put the logistic cost, handling cost, then warehouse reaching cost, transportation cost. These all are part of inventory. By capitalizing inventory cost and asset, we are delaying the expense recognition until it is sold. All inventory should be part of the assets. It should go in the balance sheet, and gradually when we will sell it, so we will expense it with the name of cost of goods sold. Costs which are not included in inventory rather expense out, and when incurred are unallocated portion of fixed overheads, abnormal waste, storage cost of the finished goods, administration overheads, selling cost. These costs we cannot put into the inventory cost. So you have to be very careful about doing your questions. This concept should be very clear that these are the things, items which we have to take in the inventory valuation. These we don't have to include. Now this is a question. G produces and sell electronic equipments. Which of the following inventory is most likely to be recognized as an expense? Based on this concept, this is the inventory, this is not to include it in the inventory. On G's financial statement in the period incurred. Now we know that conversion cost is a cost of inventory, you can see here. Then we know freight cost on input also part of inventory, which is here, you can see freight. So these two will be capitalized and this will be expensed. So if you have these information in your mind, this is a past paper question, so you can easily solve this one. Now certain tips you have to develop for yourself. Always discussion will go between IFRS and GAAPs. Why we are doing? Because being an analyst sitting in US, if we have two financial statements, one is the IFRS followed, one is US GAAP based. So the valuation of inventory is different in US GAAP and in IFRS. So we have to bring to the same, either we convert US GAAP to IFRS or IFRS to US GAAP. So the value and standardization we can achieve, and then we can start our analysis. So under IFRS, inventories are reported at lower of cost or NRV, that is net realizable value. NRV is equal to estimated sale price less estimated selling cost. What is the meaning of this one? Suppose we have a car which is, the AC is not working, tires are old, and little tuning is required. So expense of this, and suppose we can sell it in 10,000. 10,000 minus all these expenses will give us NRV, net realizable value. Whatever selling expense, because without that we cannot sell it. No one will take this car if this car is not fine-tuned, then their tires are old and any other defect is there. First of all, you have to remove that defects. That has a cost. This cost is outflow, and when you will sell it, there is an inflow. So you have to net off the selling price minus selling cost. This will be your NRV. This is in IFRS, right? But okay, now if NRV is less than the cost, then loss is recorded in the income statement. If there is a subsequent recovery, inventory can be written up. However, any write-off is limited to the previous recorded loss. This is in IFRS. Now I will show you the gap difference, which you will see. Under gap, inventory is reported at lower of cost or market value. You can see here the difference is here is lower of cost or NRV. Here it is lower of cost or market value. So it will be a difference. It will create a difference. Maybe market value is different than NRV. So market value usually equals to the replacement cost conditions. Market value cannot be greater than NRV, net realizable value. What is net realizable value? The market price minus selling cost. So naturally it should not be more than the market price, because market price less selling cost is NRV. Now and or less than NRV minus normal profit. If the cost is greater than market value, then the difference is recorded as loss in the income statement. No write-up is allowed under GAAP. In IFRS, we can write up to the extent of the cost of the inventory, but here there is no write-up is allowed. Now, what are the permissible methods for the cost flow? One is under IFRS the FIFO and weighted average. Under GAAPs we have FIFO, LIFO and weighted average. Now what effects it is going to create? If we use FIFO, the item first purchased are first to be sold. Suppose, what is that? Let me give you an example. Suppose we make the screws and we bought the raw material from the market, and we are consistently buying it January, February, March, April, May, and we have a warehouse. When our lifter brings the raw material, they throw in the warehouse. Now you don't have any segregation that which is bought in January, what is bought in February. All is mixed and they are all similar. They are not identifiable. In that case, it's just the assumptions we have to, for stock valuation. What are these? These are assumptions. We assume that, okay, now you have a warehouse, during the year you are putting your raw material. Now there is a production department. They are asking for continuously raw material. So someone comes, he took it someday from here, someday from here, someday from here, and they don't know what is the first bought in, what is second bought in, you all mix that up, right? So in that case, we are not sure using by FIFO or LIFO. It's just a mental satisfaction. We assume that we purchase first, we used first. Or we purchase the last, we use the first. So this is the mechanism behind the FIFO, LIFO or weighted average, that because we cannot clearly identify what we bought first and what we used first. So we assume first in must be first out or last in must be first out. Based on these we have to put the assumption the item first purchased are the first to sold. Cost of goods sold consists on first purchased, because we are following the concept that what is dropped first in the warehouse, it is used in production, the first one. And ending inventory consists of most recent purchases, because you are consuming from top and what is left with you is the last prices. Recent prices. LIFO is the item last purchase or the first to be sold. Now, in cost of goods sold, you are charging the last prices. You are using the last prices, keeping the first prices with you. So, the ending inventory will be on the earlier prices that is left in the store. The last you have already consumed and charged to the cost of goods sold. And in weighted average, what you do is whatever you get the units, whatever is the price, you keep it adding, divided it by total number, amount divided by units. So it will be one rate only. So items sold are the mix of purchases, average cost of all items and average cost of all items. This is the concept behind the valuation methods. Now our understanding should be not how to calculate FIFO is not our concern. How to use it, what effect it is going to bring on financial statements, ratios. This is our main learning part. Now, LIFO and FIFO comparison in rising prices and stable or increasing inventory. Suppose if we are working towards inventory which has no price fluctuations, since 2 years, 3 years, there are same prices. So valuation also will be stable. But if price is fluctuating and in the last quarter prices are more fluctuated, means more increase. So and we are using LIFO. From this table you can see here, if we are using LIFO, so last purchase will be charged to the cost of goods sold. Means if in January we bought on $100 and in November we bought on $400, so we are charging $400 to the cost of goods sold. So our cost is increasing and our operating income will decrease. On the other hand, because the closing stock will be valued on the earliest stock valuation, so it will also go with the earliest prices in the balance sheet. Opposite to this, we have first in first out. If the prices are stable, so it is not going to affect anything. Just the concept we have to keep in mind when we are using LIFO and price is fluctuating in the last quarters and we are charging it to the cost of goods sold, then the cost of goods sold will be higher